Can you imagine 2% a month just for agreeing to buy Apple for the same price it's trading at? I would much rather take that approach where I'm being paid 2%. I'm more than happy to take that one. Hey guys, Omar Khan here from Theta Trading with today's video. And today's topic is selling puts versus buying stocks. Why would I want to sell a put versus buying a stock? I'm going to show you why I think selling puts is a far better strategy if you believe a stock is going up than actually buying it and waiting for it to go up. And I'll show you the pros and cons of both and then let you know what you guys think. Before we get into that, if you find these topics to be valuable, helpful, we're trying to build a community here at Theta Trading of like-minded individuals that are concerned about getting ourselves and our families to financial freedom and literacy. I'm going to do a video one day about my story. Basically, I started from zero and through stocks and real estate, I got myself into a position of financial independence. It's a great spot to be, and anyone can be here. We want to do more and more videos to show how we got here, to inspire other people, because I know the havoc it caused in my life growing up, and I wouldn't, I don't want other people to go through that. So please consider hitting that like button, subscribe, and hit that bell notification for future videos. Also, comment if you'd like to see a certain video in here. What do you want to see? So let's get on to today's topic. Selling a put versus buying a stock. Now, first of all, let's just define what buying a stock is, okay? For a lot of people who are new. Let's say, for example, I say, well, I want to buy Apple stock. Okay, well, that's my decision. I will do the homework ahead of time. I'll look at the financial statements. For us, we read the financial statements. We use the products and services. We do a lot of homework before we decide to buy a stock. And then we run our discounted cash flow model and we do our own analysis because sometimes cash flow models don't tell you everything, right? And we come to a conclusion. And also, guys, if you want a copy of our equity research reports, send an email to support@thetatradingco.com. I'll put a link here. So now getting back to talking about buying stocks. When you buy a stock and you do your homework on this company and you say, well, I think this company will be worth a lot more in the future. In this example, Apple. We look at Apple, we look at the financial statements, which is a report card of the company's financial health. Now, ultimately, all companies are valued based upon the amount of money they make or don't make long term. So if a company continues to make more and more and more and more money, the valuation tends to go up over a period of time, everything else being equal, right? Because you want to be able to, you'll pay more for an asset that is producing more. So the first step that we do is we look for stocks that are going to be worth more in the future after doing our homework. Like I said, that homework entails using their products and services, understanding the company thoroughly, listen to conference calls, and I'm talking about the ones where their earnings are announced. And that's 4 times a year where they have to disclose how much money they made as a publicly traded company. So once we've done all that stuff, and we say, hey, we think the stock is going to go higher, well, the first choice is simply to buy the stock. So as I speak today currently, Apple is sitting at $170 a share approximately. Okay. Now, we've done our homework, and we have come up with our own equity research reports here at Theta. Again, you can get a copy of those. Send an email at support@thetatradingco.com. And we have our 1-year price target, okay? And that 1-year price target is a fair bit higher than it is today, okay? So now we've determined that. So we can buy it for $170 and let it hit its price target. And we think, and again, this is not meant to be advice in any way. Please don't take it as our own internal homework. We have a base care target of roughly $200 a share, okay? So we purchased it for $170 and we let it ride up to $200. That's a great way of doing something if you don't want a lot of time involvement or stress in the market. But you still have to put in that initial work where you have to find high quality companies that you want to own long term. Every great investor, I don't care who you are, the basis of their investments is always going to be high quality investments. Simple as that, which they thoroughly understand. If you look at most wealthy people that you know, some people inherit money, some people get a bit lucky, but the vast majority of people who are self-made understand what they're investing in and why they're investing in. So you have to put up that initial upfront work. You say, I really want to invest in whatever company that happens to be. In this case, we're talking about Apple, okay? So we buy Apple for 170 and we wait for it to go to 200, and that's a nice rate of return. Hey, it's almost 20%, right? It might even go a little higher. Our bull case hits. Our bull case is higher than that. So that's not a bad spot to be in because we've done our homework. Okay. Now, I will tell you the way that I prefer doing it and why I prefer doing it this way, and again, how this gave me my financial freedom. Once I have determined that, let's say I think Apple will be worth $200 a year from now. Okay, great. And currently Apple sits at 170. Selling a put for me is far more advantageous and it reduces my risk. Now, what exactly is a put? Well, we've done a couple videos on puts before, so watch those videos. But in a nutshell, selling a put, it sounds fancy, it's not. It's a simple way to agree to buy a stock at or below a current price, or, that's what we're doing here, okay? So, again, remember, choice number one is buying the stock and waiting for it to appreciate, which is no problem. The second way is using the derivatives market, in which case we're going to enter the options market. There are various types of derivatives. We are concerned specifically with options, and there are two types of options, both call options and put options, okay? Now, put options give the buyer of the put the right to buy that stock at whatever price. And for us, what we're doing is we're essentially ensuring the value of a stock, okay? So we're happy to take this money. Now, let me explain to you how this works. Now, Apple is trading for $170, okay? A share. I have two choices. One, I can buy it, wait for it to go to 200. Great. Second choice is I can simply agree to buy Apple for $170. And then let's say for 30 days. So I'll say, you know what? No matter what price Apple happens to go, even if it goes down to 165 or 160, it's okay. I'm happy to buy it for $170 a share. So what I do is I would sell a put, okay, to do that. Now, if I sold one put on Apple, that means I've agreed to buy 100 shares of Apple, okay? And let's say somebody pays me $3 or $4 a share simply for agreeing to buy Apple for its current price. Now, to me, that is a great return. I can get 2% a month just for agreeing to buy Apple. And if I annualize that, that's 24% a year, not even compounded. And what's the worst that's going to happen to me? Well, I'm going to own Apple. So that's what selling a put is, guys. Selling a put is you are agreeing to buy that particular stock at a particular price for a particular duration. Okay, in this case, we do about 30 to 45 days. Actually, I would say between 14 to 45 days, 2 weeks to about 6 weeks. And that's that sweet spot for us for selling puts, and there's a very specific reason why. It's because where you get the most part of the decay on the Theta decay chart. And that's why we named our company Theta Trading, is because that is our superpower. We sell options, and we simply let time ravage the value of them, which is a huge benefit to us, okay? So getting back to this Apple example, I sell a 170 put, and it's at 170. So what I'm telling the market and the options market is I'm saying, hey guys, I am agreeing to buy 100 shares of Apple for 170. Great. I get compensated. Can you imagine? Let's say $300 to $400 for that, like 2% a month, just for agreeing to buy Apple for the same price it's trading at. So for me, I would much rather take that approach where I'm being paid 2% just to agree to buy Apple for its current price. I'm getting paid a lot of money for that. I'm more than happy to take that money. Now let's look at the pros and cons of selling puts versus buying stocks. Okay, well, one of the biggest problems of selling a put is if that stock happens to go up really fast, okay? Because I agreed to buy it for 170 and let's say I got paid $3.50. Well, that's mine to keep. Great. But what if the stock happens to go really quickly to 180 and I could have made $10 on the way up? Well, that is something that you have to contend with. But from my experience, through my investing career, which is now almost 25 years, I've made far more money selling puts than buying stock long. And again, I'm totally happy to hold stock once I own them. It's just I like to acquire my stocks using puts, okay? So I will sell a put, and if I have to buy that stock, I'm more than happy to buy that stock because I've done my homework and I believe it'll be worth more in the future. So what I do month after month is I sell these puts, okay, which means I agree to buy stocks that I would want to buy anyways at or below their current market values. And I get paid a lot of money for that. So one of the pros of selling a put is, for example, even if I had to buy them, I would have to buy them for lower than they're trading for today, and I got paid for it, thus lowering my cost even more. So it gives me more downside protection. So in a range-bound market, selling puts is a great strategy. In a majorly bullish market, the issue could be that stock could run away from you. But again, like I've said, from my experience, I'm more than happy to sell puts to acquire my positions. And once I own those positions, that is a whole different story. That is where we look at writing a covered call if we deem necessary. Or we just say, you know what, there's too much upside in the stock. Let's just hang on to it. Let's not write any covered calls. For those of you guys who don't know what a covered call is, it is when you agree to sell the stock that you have just acquired or that you have for a higher price or the same price, and you get paid a lot of money for it. So getting back to this Apple example. The Apple example, let's say, for example, we had to buy Apple for $170. Great. And we turn around next month and we say, you know what? I'd love to be able to get rid of my Apple shares for $180 a share. Do you know the market's going to pay me like a 1% just for agreeing to sell my Apple shares for a profit? Now that is a covered call. So for me, selling puts and covered calls is a great way to generate income. And it gives me a great lifestyle. And I know my worst case scenario. My worst case scenario is that I own a stock that I wanted to own anyways. This allows me to sleep all night. I'm done in 30 minutes a day. It's a pretty good lifestyle. This is what we do day in and day out here at Theta. So selling puts, guys, versus buying stock. I hope you guys can see why I prefer to sell puts, because if I sell put, I get paid a lot of money just for agreeing to buy the same stock that I would buy anyways. Now, one of the downfalls of buying a stock is if you buy a stock and the market happens to go down again, you're not going to get that discount. So for me, all these various reasons, I prefer to sell puts. But the only issue is in a rapidly rising market, that's where selling puts, you'll still make money, but you will have made more had you held the stock. And these are things that you contend with, but the market goes through phases and cycles. I have just found that over a period of time, for me, it is most advantageous to get paid a lot of money to agree to buy a stock that I would buy anyways. Now, just for any of you guys who are watching these videos, we're trying to grow our viewership here, guys. If you guys find this information this knowledge to be valuable, please subscribe. We're trying to get to 1,000 subscribers. Once we get that, YouTube's going to start promoting our videos a lot more. Your help would be greatly appreciated. Hit that like button. If you want more information, hit us an email. Shoot us an email, support@thetatradingco.com. Hope you like this video. Any suggestions for future videos, let us know. It is your boy Omar Khan. I hope you guys enjoyed it, and we will talk soon. Take care, guys, and I hope to see you part of the Theta community.